Hey everyone, it's Julie here with TipRanks, and today we're taking a look at 3 strong buy stocks in the green energy sector. So let's get into it. Alright guys, welcome back. Thank you all so much for being here. Today we're taking a look at 3 stocks in the green energy sector that all come in with a strong buy consensus from Wall Street analysts, plus play an attractive dividend yield. Now, stocks in this sector have sold off in recent weeks following the presidential election. It is believed that some of Trump's policies may not favor renewable energy stocks, but even with these short-term headwinds, there is still a lot of belief that long-term growth potential lies in these renewable energy stocks. So we're going to take a look at these companies today, what it is that they do, and what those Wall Street analysts are predicting for the stock's future. Just before we get into today's stocks, this is a reminder that right now TipRanks is having their Black Friday sale, so you can take 40% off premium subscriptions and unlock some of those fantastic investment research tools that you've been eyeing. So you can follow the links in the description down below to take advantage of that sale now. If you enjoyed today's video, make sure you hit that thumbs up button and that you're subscribed to the channel. Let's jump right into our strong buy green energy stocks. First on the list today is Hannon Armstrong Sustainable Infrastructure. They trade under the ticker HASI, currently priced at $28.48. Year to date, the stock has climbed over 27%, but you can see it's cooled off more recently, and in the last 3 months is down nearly 7%. HASI is a finance company and asset manager that focuses on financing the transition from fossil fuels to renewable energy. Essentially, the company provides capital and financing resources for firms involved in clean or green energy. They have over 35 years experience in their field and currently boast an investment portfolio worth $6.3 billion. And this is split among 3 key market segments: behind the meter, which includes energy efficiency, residential solar, and community solar projects; then grid connected, which includes wind and solar power generation, along with large-scale power storage products; and then their fuels, transport, and nature, which includes renewable natural gas, fleet decarbonization projects, and ecological restoration initiatives. They've been paying a quarterly dividend for just over a decade and have been consistently growing it during that period as well. Their current quarterly dividend is 41 cents per share for a dividend yield of about 6% and an ex-dividend date of December 30th for payment on January 10th. They shared their Q3 earnings report on November 7th, where we did see mixed results with a slight miss on earnings but a beat on revenue. Third quarter earnings per share came in at 52 cents, which fell about 4 cents short of analysts' expectations, while revenue came in at $81.97 million, beating estimates. The company did confirm their adjusted earnings per share growth guidance for the next couple of years and said that they expect to continue to deliver growth in their earnings and manage assets amidst ongoing volatility in interest rates and uncertainties related to public policies. An analyst from JP Morgan recently weighed in, saying that the HASI stock was one of their top picks. He said, "We believe the company is largely tracking expectations and continue to see conservatism in the medium-term targets as project yields continue to trend higher, and the company's recent investment-grade credit rating likely benefits spreads over time. Given the scale, diversification, and maturity of its portfolio, we highlight HASI as being relatively more insulated from potential policy changes under a new administration compared to the rest of our renewable coverage. HASI is a top pick within our coverage." Overall, it's rated a strong buy based on 8 current ratings with 6 buys and 2 holds. And the average price target of $41.83 implies an upside potential of nearly 47%. Looking at those recent ratings down below, on the low end we do have a hold with an upside of about 26%, while our high-end price target comes from Oppenheimer with an upside of over 68%. Second on our list is Clearway Energy. They trade under the ticker CWEN, currently priced above $28 per share. Year to date, the stock has climbed 8.3%, but is fairly flat recently and up 0.18% over the last 3 months. Clearway Energy is an owner and developer of clean energy assets in the United States. They own a portfolio of contracted renewable and conventional generation and thermal infrastructure assets. Their assets total some 2.4 gigawatts of capacity across 26 different states, and they have a large footprint along the Atlantic seaboard region from New Jersey to New Hampshire. Their assets include commercial-scale wind farms operating in 13 states and similar solar projects across 19 states. They also own 12 gigawatts of battery storage with operations, including deployment and development in 17 states. And this is another company that has been paying out their dividend for about a decade. With the current quarterly dividend of 42 cents per share for a yield of 5.9%. Their ex-dividend date is December 2nd for payment on December 16th. Clearway did come out with an earnings miss for their third quarter at the end of October, but a beat on revenue and did reaffirm their full-year guidance. Their third quarter earnings per share at 35 cents did fall 22 cents short of analysts' expectations, while revenue of $486 million grew 31% year-over-year, beating by over $72 million. The company said they remain well-positioned to meet or exceed their 2024 financial objectives and initiated 2025 guidance, providing for robust growth and remaining committed to the financial objectives previously outlined through 2026. Near the end of September, an analyst from Jefferies initiated coverage on the stock with a buy rating, saying that Clearway is a renewable infrastructure owner that stands out with consistent, steady, reliable growth amidst a peer backdrop of missed targets and downward revisions. They believe the company can reach its 5 to 8% dividend growth target through 2026 without corporate capital needs, while contracting upside in California could further extend the runway. With 9 current analyst ratings, the Clearway stock does come in as a strong buy with 8 buys and 1 hold. And analysts' average price target of $34 implies an upside potential of over 20%. Looking at those ratings down below, on the low end we do have a buy rating at $30 for an upside just under 6%, while our high-end price target is a buy from Oppenheimer with an upside of 34%. If you've made it to our third stock today, then this is a reminder to make sure you hit that thumbs up button. Last but not least on the list is Brookfield Renewable Partners. They trade under the ticker BEP, currently priced just above $25 per share. They've gained 9% overall in the past year. They are in the red about 8% over the last 6 months, but in the green over the last 3 months, up 10%. Brookfield Renewable owns, operates, and invests in a diverse portfolio of renewable energy assets around the world. They operate one of the world's largest publicly traded platforms for renewable power and decarbonization solutions. Their diversified portfolio consists of hydroelectric, wind, solar, distributed energy, and sustainable solutions across 5 continents. Over the last 5 years, their dividend has a compound annual growth rate of over 11%. And their current quarterly dividend is 36 cents per share for a dividend yield of 5.5%. Their ex-dividend date is November 29th for payment on December 31st. They shared their latest quarterly report on November 8th, and this is another company that had some mixed results with a miss on earnings but beat on revenue. They came out with a wider than expected loss per share of 32 cents, which was 3 cents worse than analysts were anticipating, and funds from operations fell 1 cent short. Revenue, on the other hand, came in at $1.47 billion, growing by over 24% annually and beating expectations by $40 million. The company said that they signed numerous favorable large-scale contracts within their North American hydro portfolio, and that their scale and geographically and technologically diversified business is uniquely positioned to meet the growing needs in all political environments. Following that quarterly report, we did hear from an analyst at DBS. They said that the company is poised to benefit from positive trends in artificial intelligence and data center demand, which supports favorable power prices. The firm's robust financial standing, supported by a substantial pool of capital and high-quality cash yields, underpins its investment strategy without the need for equity issuance. Despite a slight miss in the results, management does remain confident in achieving a 10% funds from operation per unit growth. Their stock also has 9 current analyst ratings, coming in as a strong buy with 7 buys and 2 holds. And the average price target of $31 would imply an upside potential of over 22%. Looking at those ratings down below, we can see several analysts recently increasing price targets. Our low end is a hold here from back in September with an upside of 6%, while our high end price target is $34 for an upside of over 33%. So that is a quick look at 3 green energy stocks, all rated a strong buy among Wall Street analysts and all paying an attractive dividend. Let me know your thoughts on these companies in the comments down below. I always love hearing from you guys, and keep in mind these videos are never a suggestion to buy or sell any specific stock. Make sure you always do your own research and due diligence. Thanks so much for watching. Have a great day, and I'll see you back here next time.